Sylvain Melkin. As you can see, we're privileged this morning to have two senior executives with TD Bank with us. Sylvain Corbeil, who's Mr. Quebec for commercial and business, Quebec and Atlantic, actually. He's vice president. And of course, Derek Burleton, who's the vice president, deputy chief economist of TD Bank, will give us his opinions and forecasts or scenarios as to what's going to happen in the future, hopefully. So we'll all be a little bit more prepared. Just before I introduce Derek and Sylvain, I'll tell you a little bit about what's going on with the club. This is our 94th webinar since April of 2020, of course. Number 100 will be October 6th with Angela Nucci from Blake's, who will give us an overview of M&A activity in North America, but with a particular emphasis on Canada. They have their own stats, and they also review the ABA, the American Bar Association study, which studies M&A activities and all kinds of metrics and interesting information about M&A deals across the country. And Blake's are, depending on the year, number 1 or number 2, and I think the number of transactions that they do in Canada, at least. The gala, November 18th, is still on, and we're hoping for good things. Please get in your nominations. We've extended the deadline to September 17th. So it's online. If you want a PDF version, we can get you that. Just request it. And there's 9 categories, and it promises to be a great success like it has been in other years. Speaking of deals and transactions, we still are going to continue with our PDF that goes out every 2 weeks. The Salesforce community portal that we're working on now is not quite ready, and we want to make it as easy and friendly to use as possible. So that's coming very, very soon for deals and transactions, and of course, a special area for member inquiries and contact information. The other thing is that with 19 clubs now across Canada, we will be opening our 20th in New York City, expecting it to be in October, either at the Quebec Mission House or the Consul General of Canada. We're in touch with both of them, and they're both eager and willing to have us down there for our first M&A Club lunch in New York City. That's coming. We have our leader. If anybody any of you out there have contacts in New York, which of course most people do, please send us their name and or email so we can invite them to the first 2 or 3 lunches, which will be free, of course. There is a free lunch. The M&A Club offers free lunches sometimes. So that's it. So I'll introduce Derek. Just before that, I'm going to introduce Sylvain briefly, who's been a friend and supporter of the M&A Club for a long time. Sylvain's the Senior Vice President for, as mentioned, for Atlantic Canada and Quebec with TD Bank. He's based in Montreal. Nicholas, who you see in your screen, was the catalyst and the man who organized this morning on behalf of TD. So thank you, Nicholas, for doing this for us. And Jane Webster, that you see there, has just joined our marketing team along with Lorene, and you'll be hearing more from Jane very soon. Derek is, as mentioned, Vice President, Deputy Chief Economist for the TD Bank Group. In his role, he leads a team of economists that provides leading analysis on the Canadian US economies. Each year, he travels extensively across Canada and the US, speaking at more than 75 events on economic and financial developments. As a respected commentator, Derek has been quoted by many media outlets, including the London Financial Times and The Economist. He also is frequently interviewed on radio and television. Derek maintains a strong interest in public policy issues and has written substantive reports on healthcare sustainability, education, and immigration reform. He participates in a number of advisory and steering committees, both internal and external to TD Bank Group. Derek Burleton received his Bachelor of Commerce from Queen's University and a Master of Science in Economics from the London School of Economics. Derek has more than 20 years of experience as an economist in the financial industry. So we're quite privileged this morning to hear from Derek, and thank you, Derek, for doing this.
I thank you so much. Merci, Brian, for the opportunity today. I really appreciate that. Maybe you described Derek quite well, but maybe a couple of more information regarding Derek. So I have some pictures, I have a lot of things, but let's focus on the facts. So just want to share with the people on the line today that Derek was born in Montreal and still have family in the Eastern Township. So he still like to come and visit us once in a while. Despite many, many years in Toronto, well, as you can see with his master at London School of Economics, one of the best schools in the world in economics, he's a very smart man because he's still a Habs fan, especially after last year. I think you're on the right side of the fence, Derek, for sure. Derek still speak French a little bit, but not to worry. The presentation will be in English. You still need to practice. And Derek, we need to increase your pace. Brian talked about 94 webinar, and in your bio, there's only a 75, I think. So we need to increase the pace to get at the same level as the club. And by the way, Brian, if we can help you for your new branch in New York, it will be a pleasure. We have more than 400 branches, TD branches, in that region. A very large commercial team as well. So anything we can do to support the club there, we'll redefine the sentence. There's no free lunch. If there's a free lunch, we'll be there for sure.
I'm taking notes. Thank you for that.
Up to you, Derek, and thank you so much for your time. Everybody wants to hear about where the economy is going. And folks, you're gonna see it's quite interesting to listening to Derek because he has a clear view, and the way he explained it is quite powerful. So thanks, Derek, for being with us today. Really appreciate it.
Merci, Sylvain. It's a great pleasure, and yes, many fond memories of the Eastern Townships. My grandparents lived there for a long time, and I am just a huge Canadiens fan. I take a lot of abuse from all my friends here. I'm sort of the token Montreal Canadiens fan on the block, but what a run we had last year, that's for sure. Yeah. Quite exciting. Anyway, I guess on to more serious matters. Well, though the Canadiens are pretty serious. You mentioned, the outlook, and I've got a pretty clear view, I think. I have to say that the forecasting quality has got better as the pandemic has unfolded. I think we've learned a lot. I mean, you take a once in a lifetime, hopefully once in a lifetime, once in several generations, pandemic, economic shock. A year and a half ago, we were lost. We just didn't know what to suspect. We went from being far too positive to being far too negative. And I think things have sort of worked out as we work through into the fourth wave, heading into the autumn of this year. I think we have a better sense as to where we're headed. And by no means are all the questions answered. Some of the issues that are plaguing the economy in Quebec, in Canada overall, in the United States, are supply. And this is something I don't think we gave enough focus on early on. Again, we're learning as we go, but there is not any demand problem in Canada and Quebec. If anything, as we move into the last calendar quarter this year, it's a supply challenge. It's keeping up with demand, and businesses are really struggling, whether it be not having adequate labor, supply inputs, the list goes on. So this is one of our challenges. How do you forecast supply? Usually we spend a lot of time analyzing demand, impact, low interest rates, that sort of thing. Now we're trying to gauge global supply chains and the like. So never a dull moment in the world of forecasting. Lauren, if you can just go to the next slide. We'll start off, I think I can kind of build on this. Some of the key themes, supply chain disruptions are getting more attention of my team, certainly, of forecasters in general. How will they unfold? I think certainly the sense is that, demand has been racing back too quickly. We were, in the end, going to suffer a lot of problems keeping up with that as an economy, and we have. But some of that will be temporary in nature, but there will be some persistent issues. The Delta impact, Canada, particularly Quebec, has higher vaccination rates than we're seeing in other advanced economies, certainly in the world. That should provide us with some protection, but certainly doesn't eliminate some of the uncertainty. So I'll talk a bit about that. Two-speed recovery. Developing markets are struggling much more than advanced economies. And this is, again, something that became more evident as we moved into 2021 after the initial bounce back. Emerging markets don't have the fiscal firepower, and they certainly don't have access to the vaccines. And that's holding back many markets. In areas like China, there's zero tolerance for any kind of COVID outbreaks. So they're implementing lockdowns, disruptions. Areas like Malaysia, which are so important for producing things like semiconductors, they're all being hit harder this year than we had anticipated. And that's where the knock-on hits Canada and Quebec, because we rely on a lot of these inputs from these countries that are suffering from COVID outbreaks that need to shut down production in order to for safety reasons. So knock-on effects there. And then lastly, just in terms of financial outlook, talk a bit. We heard from the Bank of Canada this morning. No interest rate change, not surprisingly, but a bit of guidance where we see both interest rates and bond yields go in the coming quarters. On to the next slide. Just my focus will be on Canada and Quebec, certainly the United States, which is so important to the economic fortunes here. But just a few words on this two-speed economy we've been dealing with as we move through 2021. We tend to split the global pie into the advanced nations, Europe, the better part of Europe, certainly Japan, the United States, Canada, and a lot of other northern countries, emerging markets. And what I show you in the table on the right here is how the forecast has evolved. Our second quarter forecast was issued in June. That's our last official quarterly forecast. I'll give you our growth numbers, both for advanced in 2021 and 2022, and a more up-to-date outlook. And I think the key point here, and the chart on the left shows it, is that the downgrades have been much more significant among the emerging markets on the whole this year for the reasons I've mentioned. Outbreaks, lack of vaccine protection, vaccine progress, and that's held back spending activity and just supply chains in general. And a lot of these economies are more reliant on manufacturing, China being one. Now, one thing I will say is that July, our view is evolving further. Our next official forecast is in mid-September, and our numbers will come down pretty much across the board. We are not looking at, for example, advanced economies in 2021 above 5%, will probably come in a little bit below 5 in our upcoming forecast, because it comes back to the supply chain constraints are proving to be more substantial than we had expected. In Canada, it was glaringly apparent in the second quarter, just not having enough cars on dealer lots for consumers to buy, low inventories for many manufactured goods, and service industry still suffering with a lot of restrictions in that quarter. So those numbers are coming down broadly across advanced economies as well as emerging markets. But the broad storyline still applies. Growth is still going to be strong after a very, we're off very low levels in 2020 with the pandemic. So recovery is still happening, but it is, the outperformance is certainly less than we've been giving credit earlier this year. So those we're chasing numbers down a bit after chasing them up through much of 2020. Next slide. Yeah, the vaccine advantage, we went from a real disadvantage to the earlier stages of the vaccine rollout to having an advantage. And just to give you a sense, in Canada, about 70% at last count of the population had been fully vaccinated. This is of eligible population. Quebec, the numbers are running around 80%. So Quebec has the highest vaccination rates in Canada, and just the shift to the vaccine passport, if anything, is driving that rate up a little further. So the progress here has been really astounding and impressive, how Canada has turned it around. Now, it doesn't eliminate the risks, as I say. We are learning as we go. Research is suggesting that some of the protection from vaccines does wane. You're hearing more about booster shots, in the United States and in Europe. in Canada isn't quite there yet, albeit on a targeted basis, dealing with the most vulnerable. We are seeing in a number of provinces. But so we're not talking about herd immunity anymore. I think that was an idea that was sprung out earlier, that maybe we could beat the COVID-19 through vaccine. Certainly mutations are making that a bit elusive. If you are hearing talk of it still, you're talking about getting vaccination rates up to 90% or higher, given how contagious the Delta is. So I think we're now talking more about the endemic stage of the pandemic, where we're learning to live with it. Countries are trying to get vaccination rates higher, implementing vaccine passports. I'll talk a little bit more about that in a second. Vaccine mandates. And so any other alternative than the widespread lockdowns we saw in the first few waves. And I think economically, I think that's going to benefit, because widespread lockdowns are very blunt instruments that hit the economy at large, whereas we're now dealing with more strategic, targeted. And I know there's some concerns about, rights and all that with implementing vaccine mandates and passports, but that's the way we're headed. And from an economic perspective, it will be on a net basis positive. And so in other words, that limits some of the downside risks that we're seeing from the Delta itself on spending behavior and precaution among households and businesses. Next slide. Yeah, the one thing that, so we do have higher vaccination rates in Canada, but there's still talk about the risk of lockdowns. You may have caught wind of the federal modeling last week that was released out of Ottawa that talked about COVID cases reaching as high as 15,000 if vaccination rates don't continue to come up to about 85% or even higher nationally, that there is still the risk that we will see lockdowns. It's certainly governments don't want to see it, but the real challenge we have in Canada is not having the hospital capacity that we have seen in other countries. You can see this chart shows hospitalization rates in Canada relative to Israel, the UK. And notice the third wave around May 2021, hospitalization only got up a bit above 100 per capita, per million people. And the reason being is that governments had to force lockdowns at that level. They were, pretty much a hospital was pretty much at full capacity, and governments had to undertake lockdowns. But look at how high hospitalization rates got in other countries. And this reflects the fact that, the UK, they have, and it's not just the number of beds, it's the staff availability and the nurses. So this is a constraint for Canada, in that, we can tackle some of these capacity problems, but it's a medium-term issue. You can't just snap your fingers. And as we go through the fourth wave, if we start to see hospitalization rates near in on where they were in the third wave, you may see further lockdowns. So this is not something we're betting on in our forecasts. The numbers I'm sharing with you today assume some modest restrictions, and we are seeing that targeted, but not widespread lockdowns. We would expect those rates to rise, hospitalization, but not to a point of reaching, the third wave. So there is still uncertainty here, and hopefully some of the measures, these targeted measures, will take pressure off hospitalizations. I think the other trend we're seeing that's positive is that the Delta, with vaccination rates, you're not getting the severe outbreak. And we're seeing it, we look to the UK for a lot of evidence there, and there still is quite a gap between COVID cases and hospitalization. So those rates remain quite low. So there's hope that with vaccination, it's not going to, certainly hear about breakthrough cases, it's not going to eliminate it, but certainly it'll keep pressure, hopefully pressure on hospitals down well below where we were in the third wave. So we'll be watching that as a key indicator. Next slide. Yeah, vaccine passports. I won't go through the chart. I think one of the points here is that, Quebec has been a leader in Canada on this front, moving ahead. We did see governments globally move from an experimentation stage in May to more full-blown vaccine passport systems late in the summer. And Canada is a little bit behind, but we're seeing more provinces jump on that bandwagon. Ontario, BC, Manitoba, Newfoundland. Half the provinces now are pushing ahead with vaccine passports. And on top of that, businesses are pushing ahead with a lot of vaccine mandates. So again, this is an alternative to widespread lockdowns that we are seeing more in the endemic stage. The jury's a bit out on how effective it will be, but it's certainly, you know, in our forecasts, we're giving, you know, some benefit of this to keeping, as mentioned, hospitalization rates down and the sheer number of COVID cases. The international vaccine passports is certainly something that we had anticipated earlier this year being very widespread. I think the shift there is more domestic use of vaccine passports than we had anticipated. Next slide. Yeah, so on the US, you know, a lot of focus on the markets on peak growth. And, you know, you need to be a little bit careful with this concept because, you know, we had, one would expect as we V-shaped back, we rebounded back from the lows of 2020, that growth rates earlier on would be phenomenal. And since then, naturally, you get a slowdown in growth to more sustainable levels. And growth is still well above historical levels. To give you a sense, even with the US, look at the TD green line there. That's the expectation for US growth in 2021, how it has been coming down in recent months from around 6.5% this year to around 4.5%. And even those numbers will continue to come down. Some estimates are around 5.5 for 2021 growth. 2022, by the way, is holding up at a pretty healthy 4%. But I think, again, some of the downgrade reflects the fact, just this realization that the US did better earlier on in the pandemic, as some of that room to grow has been used up as the demand has sprung back, but also some of these issues I mentioned, supply challenges hitting the US. They're very short in labor supply. Some of Canada may run into more problems as we get a little deeper into the recovery in terms of the available skills supply. But the US is also battling with production shortages as well. And I've got a good chart on that coming up. But that growth, by the way, is still strong. I think that's point, but the markets are still, they look at, it's kind of the glass half empty, that growth, the best of the growth is behind us. And certainly the bond market, bond yields have been coming down a bit on this lately. Again, I'll come back to some of the financial outlook in a second. But growth is still strong, but has been coming down as we move through the course of 2021. Next one. Yeah, the leading indicators for the US is still strong. This is why we had, you probably caught wind, if you track a lot of the focus on the job market, we had August non-farm payrolls in the US out last Friday, and they were quite disappointing, albeit not as disappointing because that week number we had in August, 250,000 payrolls. The hope had been that we would have seen around 500 to 750,000 created in the month of August. That's new job gains, and that fell well short. But we had upward revisions to prior months, and the US is coming off 2 months of about 1 million per month job creation. So some payback was likely. We did see that. But I also look around at other indicators. We look at purchasing managers indices. Anything north of 50 generally points to growth in both the manufacturing side on the left, and we have a service PMI on the right. And those numbers are still elevated. So this is where we come into you know, these cross currents behind looking too much at one data source like employment, which has been slowing of late, and then some of the early indications of precautionary spending as the Delta impacts are, you know, we're hearing of, you know, concerts being canceled, some targeted restrictions, companies pushing back a return to office. This is all kind of on the negative side, but some of these numbers still point to a strong above trend growth. So our forecast kind of balances a lot of these as we move into the fourth quarter. Next slide. Yeah, just to show you how supply constraints are leading us to kind of, you know, as we do still see healthy growth, but bringing down our estimates in the second half of this year. The two lines I show you kind of give you the production shortages. That's the inventories. Look how low inventories are. This would be a lot of shortages of semiconductors, inputs. It's extending beyond just chip shortages. You're hearing shortages of other materials, a lot of it, you know, high tech in nature, but not all of it. Some of it even due to commodities. And I know that commodity prices are starting to flatten out. They're still high, but we're starting to see some rollover in terms of worries about shortages of commodities. Prices are down from their peak, but they're still elevated. But the inventory to sales ratio is at historic lows. And that's something that, in a sense, there's upside to growth potential as we work through some of these shortages into the early first half of next year. And we do see it happening because we've got a good chart in that in a second showing how we're getting a rotation in spending from goods, which really featured largely, a lot of it through e-commerce platforms. As economies trend towards reopening in the United States and Canada, you're going to get a natural push to service production. A lot of that pent-up demand, the trips, was beginning to happen. And then Delta kind of put a little bit of cold water on it, but still not eliminating that uptrend. But as we get that rotation more fully in 2022, you're going to get some relief off the production shortages. But then the other side of the coin, the job openings, that's the labor shortages, which probably, if anything, affect service industries more. You're getting, as some of these benefits, the extended unemployment insurance, they expire, you would expect more workers to get back into the marketplace. But even then, it's going to take a while before some of the pressures on wages and the like begin to subside. So we're dealing, as we move into the tail end, with these severe shortages, and our expectation is naturally, as you get a rotation in the economy, some slowing in growth on the goods side, you will get some cooling and more workers into the job market. I think will cool some of the labor shortages, but it's a trend that we keep pushing back in our forecast. And if anything, I think our September forecast will reflect more of that. That's still healthy growth, but less growth than we had anticipated. Next slide. Yeah, the other thing when we work through the endemic stage, and this is among advanced economies, again, developing markets aren't going through this. They're still in the pandemic stage with high case counts, low vaccination. This is more of an advanced economy problem. You're going to get challenges as you work through it. England was case in point of that when, they set up their tracing system, which if everybody had it on their phone and you came in contact with a positive COVID case, you had to quarantine for 2 weeks. And just the ping-o-matic was, and my sister lives in London and she got pinged 3 times, I think, within, I think it was about a 2-month span. And, I think at the end, England has softened the quarantining, but it shows you, that system was put in place, hopefully to have benefits. We're going to eliminate restrictions. We'll still keep the tracing in place. But in the end, it had unintended consequences when everybody was getting pinged. So they're beginning to address that. So that's the left-hand side. That has slowed some of the UK progress, even though they're doing quite well as they recover. And then on the right-hand side, of course, some of these indicators of shortages are the global freight indices. Notice it's beginning to flatten off. Maybe we're beginning to see the peak, and you could refer to that in commodity prices. Some of the signs of these supply chain issues are beginning to clear a bit, but still remain very problematic. And I'll come back to inflation because, I think one thing we are, as growth slows, down because of this, the other side of it is prices get bid up and inflation will be a bit more persistent than we had expected. And certainly our expectations on inflation in Canada and the US are higher than consensus overall, and we factored that into our interest rate forecast. I'll come back to that in just a second. Next slide. Yeah, so on to Canada. So just in a nutshell, the US is fighting through the Delta wave. We don't expect any widespread lockdowns that are really going to take a bite out of growth. If anything, some of the impact is more supply in nature, but doesn't change the story that the US is still deep into recovery mode, and we can expect that into 2022. Canada is a very similar story. And if anything, our job market is further along in the recovery than the US job market, but our output recovery is lagging behind. The economy got hit harder in 2020 than the US did, and our rebound has been a little bit less forceful than the US. And those numbers as well for Canada are coming down. This is our June forecast, 6% for 2021. Our updated view would be somewhere closer to 5%, given some of the weaknesses we saw, third wave impacts on the second quarter, and some of the supply challenges also showing through. Our 4.5, though, I think is tracking well. So 2 good years for growth, but again, we've been dialing it back a bit to reflect some of the Delta risks and the like. Next slide. Yeah, this rotation in spending is kind of key, I think, to dealing with some of the inflation worries as well, the goods, the tightness for goods and some of the supply chains. Canada doesn't quite have the same labor challenges, albeit small businesses, and they are very worried about labor shortages. They typically are, but if anything, we've seen those numbers really come up a bit. But I would imagine it'll become a little bit more of a challenge going forward. But I guess the good news is that, as the economies reopen, I think we will go through that adjustment as well. But the spending rotation, I think, is clear that goods has been such a big part. In fact, goods related spending is well above pre-pandemic levels. And where we're seeing a struggle is on the service side, well below, I think a good 20% below pre-pandemic. And that rotation should happen, albeit maybe a little less even than we thought, given some of the Delta impacts in the short run. Next slide. Yeah, the other thing, so there are a lot of forecasting uncertainties. Again, a bit better handle on things than we were a year ago, but still trying to gauge various things. The one uncertainty we have, we do know that with all the pandemic supports, services being shut down through a lot of the pandemic, that households have been accumulating a lot of excess spending power, a lot of excess savings. We figure close to 300 billion in higher savings than would have been the case without the pandemic. So that money could be redeployed to spending, but our sense is only a small share of it will. A lot of it's been invested in the market, into real estate. A lot of it is just likely to be held on in terms of cash balances in accounts and not be spent. Generally, that tends to happen. You spend out of income at a much higher rate than you do out of wealth. But still, even if 10% gets spent, that's what we're assuming in our forecast. That gives the consumer spending outlook a real boost into 2022 and 2023. A lot of the assets, as mentioned, have been in the form of financial assets, which are fairly liquid. But again, though, we don't want to be too heroic in our assumption here. We don't have a lot of precedent in which to gauge it from, but we'd rather leave some upside risk. And the debt growth has been slower. Canada, of course, has high household debt. That's really a national story right across the country. Some of it related to real estate boom. I'll get to that more in Quebec's in the Quebec narrative in a second. But all that to say that money is sitting there that could be deployed. And that savings rate is still going to remain quite high out of income in the next few quarters. We're assuming very cautiously only about 10% of that gets spent. But even with the demand and the income flowing in from a job market recovery, you still get some outsized growth in personal spending in the quarters ahead. Next slide. Yeah, the consumer's doing quite well, and we have that excess saving. You can make the same argument for companies, corporations, holding on to higher cash balances than typically the case. Investment has been a lagging area of the economy, and I know Canada has struggled relative to the US on the investment growth performance for a number of years now. The one area that's been quite strong, it's the yellow line, that's investment in intellectual property products. That is above pre-pandemic, but the other areas have been disappointing, holding well below where they were pre-pandemic in terms of level of investment. And if I compare to the US, I don't have the US shown in the chart here, where they have seen a huge run up is in equipment and machinery spending. A lot of it being automation, given some of the staff shortages, automating instead. Canada, based on survey intentions, should see a real makeup in the coming quarters, very strong performance. Until that actually happens, our forecast will be a bit cautious about it. The delta, if anything, is a little bit of a near-term drag, but overall, we assume further investment recovery. Some of it's just a makeup off very low levels, but hopefully we get surprised on the upside, because again, cash on balance sheets could get deployed, very similar to the household argument. But until that happens, we will reserve a little bit of caution on that front and not be too heroic in our assumption. Next chart, please. Yeah, if you're wondering, hey, I mentioned earlier about small businesses citing some of their worries about the economy. This is the latest survey out of the CFIB, the small business, the small and medium-sized enterprises, where they see challenges. Notice how you've got pre-pandemic average 2019 we use versus the latest reading in August. And you can see where the changes have been most significant. The input shortages, the distribution constraints. So a lot of this is goods related. Labor shortages would be more of a service story as well, blended in. And then you go down the list, and some of these areas aren't quite as concerning, in areas like working capital and the like. Some of it helped by pandemic supports that are beginning to get pulled away. But all that to say that really what you read very clearly from here, we're seeing it in the United States showing up in even bigger numbers is some of these shortages. Again, come back to the fact that with demand springing back quicker, this has happened. And our assumption would be that some of these would be temporary in nature. We work through them. It's just going to take longer than we had expected a few quarters ago. We're probably dealing well into 2022 to see some of these get back to more normal levels. And until then, it's going to choke off some of the growth recovery. Next slide. Yeah, inflation. So I guess it comes back to this inflation story. We know in Canada, our inflation rate has moved up to about 4% year over year. It's not as bad as we've seen in the US. The US is running well above 5% right now, inflation. I mean, who would have thought we'd be seeing inflation like this when frankly, economies had trouble even getting inflation to 2% and holding it there in recent years, and so again, come back to what's been driving it. I think the one thing that stands out, a couple of things, it's been the shelter component tied to the housing boom and a lack of housing, both rent and home ownership capacity on housing, and the transportation, as we've seen a reopening in services. Areas like airline prices have really been rising sharply. Our view would be, we'll be marking up this forecast in the near term projection. We'll probably be seeing inflation rates run north of 4% heading into 2022. And then you will see a dialing back in inflation, because some of this is just base effect. This is because prices a year ago were so low as we work through the early stages of the pandemic. They are improving. As we get reopening, things have really turned the other way. The question we're having is how much of this may be more persistent. Housing is an area that will prove to be a bit more persistent. And I think we'll be giving more credit to that in our upcoming forecast, looking at inflation holding at around 3% a year from now. I think in an earlier view would be around 2.5%. That's still quite elevated and be at the high end of the Bank of Canada comfort zone. It will mean higher interest rates, probably by the end of next year. And bond yields will begin to reflect that and come off their very low levels. I'll give you a bit more on the financial outlook in a moment, but I think that's kind of where we're reading on the inflation side. Next slide, please. Yeah, this is an old forecast. The bars on the right show you where we kind of saw a more sustainable rate of inflation. It was 2.5. I think our upcoming forecast probably pull that up closer to 2 3/4, maybe even getting to 3%. We are in a higher inflation environment. Some of this just reflects a lot of liquidity in the market, loose financial markets, tight job markets. Quebec has got among the tightest job markets in Canada at the moment, but not alone. And this is going to keep inflation on the elevated side. I don't buy into the view that we're going to be going back to 2% anytime soon. So more persistence on that front. Next slide. Yeah, so where does this leave us? In terms of a job recovery, and Quebec is a little bit further ahead than Canada, but Canada is still further ahead than the US. So it's sort of the flip. The US, I think part of it has been on the policy side. A lot of the design of pandemic supports pushed a lot of Americans to the sidelines. They will start to come back. That's our expectation, as a lot of these pandemic supports begin to expire, like extended unemployment insurance benefits. In Canada, more of the policy design was geared towards keeping attachment with the employers, in terms of some of the lending supports and the like. But what we show you here, I know there are a lot of lines. It's the TD green line, would suggest that about 10 quarters into the recovery, we'll get back to a more normal level of employment in Canada, whereas in the US, it's going to take about 12 quarters to get there. Actually, even longer, about 15 quarters. So the US still has slack in its job market. But again, part of that is reflecting the fact that Americans are not getting back into the market as quickly as many had expected and hoped to see. But this does suggest that recovery is still very much underway in the job market. We get the next lot of numbers on Friday for Canada for August. We'll see whether the job recovery remained, in decent shape. And I expect it will. About 50,000 were probably created in August. But it does suggest that the Bank of Canada will be taking interest rates up. And they remain optimistic. We heard from them today that they've been disappointed at some of the recent output numbers in the second quarter, but they still expect a strong performance and recovery going forward. And they don't seem to be overly alarmed about the Delta variant at the moment. So that was kind of my key takeaway from the communique released by the central bank today. Next slide. Yeah, in terms of the yield curves, just to get into more of the central bank outlook and the interest rates, a lot of focus in the market on how low longer term yields have been. We know the short term interest rates have really been pinned at around zero as central banks in the US and Canada and other countries have been, setting extraordinary monetary policy to try and work through this unanticipated shock. They're still going to leave rates low for a while longer. I think the surprise has been more that longer term yields haven't come up higher and reflecting more of the inflation risks and labor shortages and the like. But part of that, I think, is just due to the fact that, investors are still seeking safety in these longer term bonds. And a lot of the money flows from the rest of the world into Canada and the United States where yields are higher, and that suppresses bond yields. Now, I still expect that we're at the low water mark for longer term yields. We have a year-end target for 10-year government bond yields at 2%. They're around 130 right now. That's 70 basis points. That may be a little bit high. In our upcoming forecast, we may be dialing that back to about 175, but it still implies an uptick. And I tell you why. And so that means a steeper yield curve. I know here we're showing the difference in 10 to 2-year yields. We've seen a widening in the spread. I think we just expected it to be wider. You can see our latest forecast dialed it back a bit as we move, look ahead to 2022. If anything, that may be a little bit lower as well in our September forecast, but still a widening spread. I think that's important. That's consistent with recovery. Now, why do we think yields will go up? If you just go to the next slide, Lauren. It's because we don't think they're, fairly priced. If you adjust for inflation, real inflation adjusted yields are still extremely low. And I know uncertainty explains part of that. Delta, will there be more mutations? A lot of things to worry about. Will there be other unanticipated surprises? That explains certainly part of it. We just think that, this is a temporary phenomena and some of it will unwind as it has in the past. You can see we had a bout in 2012 with the European debt crisis where you see the shaded below zero, that's the real yield, was negative. And we've seen that for a while now. We still see the yields being negative at the longer end, but just that some of that will dial back. So that should contribute to higher longer term yields, even as short term yields remain zero as we move through a good part of 2022. Higher yields will steepen the yield curve. And that's healthy. I think we usually get a steepening yield curve at this stage of a recovery. And that would be more consistent with what we've seen in past history. Next slide. I think, our guests, so that's one thing that we'll see as higher yields. And some of it will reflect the fact that central banks will be buying fewer bond yields. Bank of Canada is already buying fewer yields through quantitative easing. The Federal Reserve, by the way, hasn't even begun to pare back its buying of government debt in the market, but it plans to. It's signaled very clearly. I think the question we have is when will they start to raise their short-term rates from zero levels? And I think the market is thinking, it's probably going to be sometime in 2023. Our view is that by the end of 2022, they're going to begin to raise rates. Now, the one thing I would argue, and I wouldn't get too focused on all the dots here, this is just the views of the Federal Reserve officials on where they see short-term rates, longer term, 2023. It's a scatter plot. It shows you the various views. You can see the direction. The markets are only expecting that longer term, short-term rate to get up to about 1.25%. So they're very, what we call dovish. They do not expect rates to rise very long. And the Federal Reserve officials, even though they've been dovish, would argue that they should come up quite a bit higher than that, up to around 2.5%. So there's a real disconnect there. Who's going to win out, we'll see. But I certainly, our bond yield forecasts assumes that maybe the market is being a little bit too benign about short-term interest rates, that they will come up over the longer term a bit higher. And that's consistent with our 10-year yield forecast that is between 2% and 3% over the long run, albeit that's still fairly low. I think we can all agree. It's just compared to the current level, it's much higher, 130. Next slide. Now, the Canadian dollar, and we could get into some of the election discussion here. The Canadian dollar has not been performing as well as we would have expected. Our view had been earlier this year of a currency over 80 cents. It's now down below 78 US, around to about 78 US cents. It's been a disappointment. Some of that has been due to some of these increased worries about growth in the global economy, about Delta risks, and other factors, and commodity prices haven't performed quite as well. So it's pulled the currency down a bit. I wonder if election risks may be factoring a bit into the discount on the Canadian dollar. Polls are suggesting that we might, and I'm not saying we will, I think there's still a good chance the Liberals pull off a minority government, albeit majority looks a bit of a stretch, but it could swing to the Conservatives, and some of that may factor into uncertainty. Some of the policies may be worrying the market. We do know that some of the Liberal policies on taxing the financial sector certainly played out in some of the stock prices on the S&P TSX. But all that to say that I don't think it's been particularly helpful. It hasn't been huge, but not helpful. I think all I can say is I can't predict the election outcome at this stage. I don't think we can. It does look like it's going to be a minority government, could be a Liberal. But I don't see, even if it's Conservative, I mean, the policies aren't, I mean, there are certainly clear differences. I mentioned some of the tax policies. The Conservatives really don't embed a lot of higher taxes in their platform, and they'll be releasing a costed platform today of their commitments. So we'll get a load of where they're going to make the money, given very large spending promises in areas like healthcare and housing and the like. But all that to say, from a market perspective, both parties promise a very gradual deficit elimination. The Tories, I think, are 10 years from now, they're going to bring the debt to zero. The Liberals are kind of in that zone based on their updated fiscal projections. From a bond market perspective, I don't think there's a big wedge issue there. I think both is a deficit falling. And then you get into the views on various policies. You may have some questions later on it, but I think for now I'll leave it at that. I think in terms of the Canadian dollar, we're still in the zone. I think we'd probably be about 80 cents years from now. I think once we get over the hump, Canada's growth should be okay a year from now. And I think hopefully some of the worries about the pandemic will continue to abate a bit and pull the currency up to around where we see it should be trading at, which is around 80 cents based on fundamentals. Next slide. Yeah, I think just a couple, I know we're kind of running late here. Just a few thoughts on the Quebec economy. It's done very well. Quebec has outperformed in the first half of this year relative to Canada, certainly relative to Ontario. I think the higher vaccination rates have helped. The housing market has outperformed, and that's provided a lot of stimulus to the economy. And it's not been a huge outperformance, but it has been outperformed. I think BC and Quebec are still, in our view, the strongest performing economies among the Canadian provinces this year. And in 2020, you to expect a bit of a step back. Some of this growth has been made up. Not a lot of excess capacity in the economy. So naturally expect growth to pull back, but still remain above where we traditionally see growth, around 3.5%. Next slide. Unemployment rates are now down pretty close to where they were pre-pandemic. So unlike in a lot of provinces, still hanging above. I'm not saying that, if you look at broader measures of unemployment, they're still on the elevated side, whether it be including underemployment into the calculation, still some spare capacity there to get mopped up. But the headline rate is down around 5% or close to. And that's pretty much where we see the unemployment rate over the longer run in Quebec. Next slide. Yeah, one of the things, it'll be interesting to see this rotation story. The green line is the high touch services, high contact services, where we haven't seen as much recovery as we would have thought, would have hoped, and we'll see whether some of the vaccine passports, high vaccination rates help Quebec's service sector get back to where it should be in terms of a level of activity. But notice the flip side of that is the housing market operating well above pre-pandemic. And we're going to see a convergence in these areas over the next 6 to 8 quarters. The question is to what extent, and it could be a bit more uneven. But housing is an area that worries me a little bit, because if we go through a more difficult fourth wave and into 2022, Housing certainly has scope to pull back quite a bit. And we're seeing some evidence of that show up in sales. It's just a market that's been so heated and bumping up against capacity constraints, whereas the service side may be a little slower to recovery. Certainly some of the tourism industries will remain hard hit in particular. And just some of these areas are very L-shaped. So, but we do expect convergence, some of these, as the economy continues to recover. On to the next one. I'm at really pretty much at the end here. Just a couple quick thoughts here. Housing, we feel sales have peaked on the left. In Quebec, these are home sales. Expecting sales really to revert back to where they were pre-pandemic, which I think if you go back was actually a pretty good housing market in Quebec. So low rates are still going to be supportive. It's just we've seen the best of the froth in the past and see a continued decline to get back to pre-pandemic. And housing starts, same thing. I think just based on our gauge on units under construction, it's been quite a run. And some of that will be cooling again back to more pre-pandemic. I think the chart distorts it a bit because we start at 30 on the right-hand side there. That was still decent market pre-pandemic, but because we don't go to zero, it looks like it's pretty low. It isn't. So I just point that out. Next slide. Yeah, population, in Quebec, it is running lower. It was running at 1.2% pre-pandemic, close to zero now. I would expect there to be a rebound next year. I know the government right now is working with the federal government to increase temporary foreign worker inflows and the like. So some of the labor constraints from weak population growth will abate as the business sector pushes for more skills. But still, I wouldn't expect us to get all the way back to where we were pre-pandemic immigration flow. There will be more of a longer term legacy that will hold it back. And that applies to Canada as well. Next slide. And this may be the last one. Yeah, just on Quebec Fiscal. The government, by the way, is operating above where it thought it was in terms of deficit in the March budget, $2 billion better. So I think the deficit's around $10 billion for this year. It was 12 at the time of the budget. Better economy has contributed more revenue. Our view on the Quebec's fiscal situation pretty much ties back to the budget is that the debt level is going to remain quite stable. The recovering economy helps to generate revenue, but Quebec was among the governments that keeps the spending taps open over the medium term to address some of the longer term issues in healthcare, some of the technology challenges, tax credits for investment and the like. So this all comes at a cost. And so we gave it credit because some of the focus in the long run, I think, was missing in some of the budgets. It was very focused on the pandemic. And Quebec did look beyond that to address some of the longer term challenges to growth. So gave it credit. The offset is that the debt level won't come down a bit. It was coming down very steadily pre-pandemic, and now it kind of sits at around 44%, which is still lower than in Ontario. It's expected to remain close to 50% over the medium term. So covered a lot of ground. Hadn't remembered my presentation being that long, but a lot of areas to cover. So hopefully we do have a little time for questions after that. Hopefully I didn't eat too much into my time. I'm certainly happy to answer any questions if time permits.
Yeah, Derek?
Yes, yeah, Brian.
Thank you for that. I was going to ask a question about China, but I guess Ontario is even more interesting for us all than China is right now. This is a national webinar, so there's people from all over the country. But I'm wondering, why is Ontario lagging in so many of the metrics where Quebec is, leading them? I'm wondering if it's just political management or mismanagement, or is it structural? The automobile industry maybe is more affected than it was in the past. I'm just wondering if you could comment on that.
Yeah, so just to point out, yeah.
Change rooms here. Go ahead.
Yeah, it's, by the way, I too have a construction going on nearby. They've been very quiet. And I do have a dog as well that probably has heard me present on the economy so much that I could have had her do it instead of me. But all that to say that, Ontario has been lagging Quebec, not hugely. I mean, both economies have been following pretty much the same contour, a big decline in 2020, a rebound in 2021, an expectation of rebound next year. But it is true that Quebec has been outperforming Ontario, a bit of lesser decline in 2020 and a bit more forceful rebound. Unemployment rate is back closer to its pre-pandemic levels. I would chalk it up to a few factors. The fact that Ontario has imposed on average tighter health-related measures, and even as recently as the third wave. And I think you hit the nail on the head in terms of some of the mix of industries, a bit more geared towards areas like the auto sector, with all the big parts industry and the like, where supply constraints have been more biting. So that has proven, at least through this year, to be more of a factor holding back Ontario's recovery relative to Quebec. Quebec, all things equal, their housing boom has been a little bit stronger than Ontario's, more momentum pre-pandemic, and I think that's provided some ancillary benefits. And I think the spending at the margin may have been a little bit stronger in Quebec. Not a huge difference there. I mean, governments opened up the taps through the pandemic, but Quebec provided a little bit more spending, I think. So you add those factors up, and it has contributed to outperformance. Some of it's more sustainable than others. I think housing is one area that, you know, why we have Quebec settling down a little bit lower growth next year relative to Ontario. Part of it is less room to grow, but housing coming down a little quicker in Quebec, given its strong performance, is part of that.
Yeah, there's a question about that. The other one is Alberta. You know, it's very confusing because poor Alberta, you know, it's up and it's down, and then it goes up and it's down over the decades. And you know, they don't have the XL pipeline and other pipelines, and they've lost hundreds of thousands of jobs. On the other hand, you have commentators say, actually, with all the bad news, actually Alberta's pretty good. You know, if you take a high level view of Alberta, it's doing just fine. So it's confusing. And I wonder if you could shed some light on that.
Confusing because there's the short-term story and then the longer-term uncertainty story. I think, you know, clearly Alberta's biggest challenge right now is figuring out how it can evolve economy in this. Obviously, we operate with an environment of a push towards net zero emissions in the next few decades, and that's Alberta. Like, where are they going to come up with the bounty that they've earned from oil and gas? What will replace that? And so that economy, a lot of this is longer term questions. It's not going to happen overnight, but that still remains a huge challenge for the province. Now, separate that from the current situation, which is an economy like others that was hit by COVID. It was already quite weak before COVID because its oil sector, remember, we had the 2015 oil price implosion. The economy was just recovering from that, then got hit again. So it hadn't even got back on its feet again. But the near-term growth story is quite constructive. Investment is rebounding. Oil prices have been higher on average this year, even if they cooled off a little bit of late. But prices are higher. The deficit in Alberta has come way down because of higher revenue from just higher oil prices. The deficit is down around 7 billion this year. Investment is improving. Consumers are getting back into the spending game. Restrictions haven't been as tight in Alberta. Now the question is fourth wave. To what extent may they suffer a more severe fourth wave? Where does that leave us? Well, it leaves us to upside recovery potential in the next year. That's probably more than Ontario and maybe more than Quebec. But certainly the big worry is longer term, medium to longer term. How does that economy evolve? And we'd need a whole seminar just to dig into that. A lot of questions there. I'm not so negative in Alberta. I think it'll find a way, but it's very uncertain at this stage. So you got to separate short term versus longer term.
We have some question. Maybe we can go through the question. Okay. So first question: what do you think the impact of tight labor markets will have on wage pressure and its impact on inflation?
Yes, it's a great question. I think I was just actually looking over the wage numbers in Canada, and I know they can be very noisy. We don't have a very good Canadian, Quebec, Canada provincial wage gauge that I have a ton of confidence in. We tend to use measures like average hourly earnings. And I think based on that, the wage measures aren't particularly problematic at the moment. They are improving, but not as hot as in the United States, which may be a little bit further along in terms of just dealing with this tightness that I spoke of, the the mismatch in skills versus, a lot of job vacancies, but finding skills. Canada's seeing a bit of that, but not quite to the same extent in the US. We may. So I think my view is that wages in this kind of environment are going to continue to pick up. I don't see how they can't. I think the question comes to what extent. And I think the hope is we're kind of coming back to the fact that some of this tightness will be short-term in nature. I think it's people, they've been, at home, they've been thinking about their careers. Some of them will change out of services and other areas. This is going to take a number of quarters to kind of work through. And even then it's a longer term story. But in terms of the severest part of the mismatch, you can see that, dragging out a few quarters. And so hopefully, it means higher inflation. I think I spoke of that. We're worried about inflation showing more persistence, and wages is part of that story, but not inflation getting out of control, and meaning that the central bank's going to have to really tighten aggressively to kind of keep it at bay. So it's a fine line there, and there's uncertainty. We may be wrong. I guess the flip side is that, maybe we're just too worried about inflation. Inflation has proved to be, it undershoot our forecast. So maybe we're just being a little bit too. So risks on both sides, but I prefer to be on the area where wages, inflation in general is probably going to be worse than many expect. And it's going to mean the Bank of Canada is going to have to raise rates earlier by 2022, year end, not 2023, as many of my colleagues anticipate.
Thanks, Derek. And we have another question. So maybe it will be short to reply for this one, but let's try. Is it possible to provide an outlook for the Ontario's economy?
For Ontario's economy? Yeah, I think Ontario, again, would follow the same storyline where, we're fully in recovery mode. I think if anything, it's a bit more stop and start than we would have hoped for. I think, and some of that came through in the recent GDP numbers in Canada, and Ontario is 40% of that. So the second quarter GDP was weaker than we expected, and the third quarter looks like it's starting off on a weaker footing than we had expected. And Ontario would account for a lot of that. I think the third wave restrictions, well, I still feel the economy has shown more resilience to the pandemic than earlier in the pandemic. Of late, there still is the impact of widespread lockdowns. And Ontario had quite a bit of that in the second quarter, and even into the early part of the third quarter, still weighing. As those restrictions have been lifted, we would have expected a big bounce back in the third quarter into the fourth, but the Delta now raises some concern there. So I think if anything, we're going to be deferring some of that growth to 2022. That may pull up our growth forecast a bit. But so overall, I just come back to the fact that recovery is still happening. It's just been a bit more uneven, and that next year should prove to be hopefully another good year for growth rate as we are a little bit further in the recovery. Stronger, more broad-based growth across goods and services than what we've seen this year, which has been very goods related, not enough services, and been more uneven given, we're still adjusting to the pandemic as we move into the endemic stage.
Yeah, I'd still like to ask about your feelings on China. Again, a little bit confusing. If you believe the pundits, we have very poor political relations with China now. Yet there's still investment going in there. Do you have a sense from your big corp clients that they're still investing in China, or are they pulling back? There's geopolitical, there's saber rattling with Taiwan and what's going on in Afghanistan in terms of the China influences, etc. So I just wondered if you had a feeling for what's going in there, and the other, trade towards Canada.
Yeah, I think certainly financial markets have spoken. That you tend to get more vagaries in financial markets of inflows and outflows. But I think some of China's authoritarian decisions that we've seen of late that have pulled a lot of money out of the tech sector, just given the fact that it's all about security and they want to exert more control around privacy and all that. That's certainly leading to a lot of antsiness, and you've seen a lot of pullout. We've seen it reflected in markets. I think there's going to be some legacy there. It seems like China really is on kind of a new, we know they've oscillated a bit between, shifting more to a market-based economy. Now they seem to be pulling back away from that. and it's more about more equality across China, addressing some of the wealth inequities. It's more been about privacy, about eliminating some of the excessive power of certain corporations. And I think that's certainly something that's going to lean. So I'm not saying people aren't going to take advantage of opportunities in China from a financial market investment, but I think some of the decisions are giving a lot of people pause. That and the fact the economy there is struggling relative to where we thought we'd be. So I think that the 1-2 punch, I think there's some legacy. Now, in terms of direct investment, I'm not sure the story's changed dramatically on that front as of yet, but some of the decisions will no doubt give some investors pause, even from a long-term perspective. Even if Afghanistan, we've been reading about that, it's just the US and China really, kind of butting heads, and any kind of political development, it seems like, okay, US pulls back, China uses an opportunity. So it really is going to be, it's a big risk. I know all the focus has been on COVID and the like of late, but certainly these geopolitical shifts are really important in terms of driving the long-term outlook. But just some general thoughts there. It's a complicated, confusing question, as you mentioned.
Yeah, I'm sorry to extend it, but we want to take advantage of your good services. The other political question maybe is the Canada-US border. If you have money, you can fly into the US. If you don't have money and you have to drive, no, you can't go in. So this is a Biden deal. You can come in from any country, but no, you can't come in from Canada. So I don't know if it's, maybe someone would say something that Trudeau did, or something that Trudeau did not do, or it's softwood lumber, or I don't know if there's other issues, but there's sort of no logic to that border. I mean, as you said, we're a higher vaccination rate than they are, much higher. So do you have any thoughts on why the land border is closed that way?
Yeah, I think, there is a political element there. And, I can't speak for why the Bush administration, the current administration, Biden administration, keeps extending. I would have thought there would have been a bit more coordination. So I'm not close enough to understand the wedge. I mean, I guess from a Canadian perspective, opening the border, the tie-in can be the high vaccination rates, and that we're feeling more confident. Again, I hear you. There's the question as to why we're, allowing Americans in when vaccination rates are a lot lower, but it kind of folds into the story there that, we're getting more back to normal because of high vaccination rates. So maybe that's part. We have no control over the US decision in the end, whether they allow Canadians in. So whether that played a role, but all that to say that, yeah, I don't know when the US is going to knock down the border controls there and allow Canadians. We're starting to see some evidence that caseloads in the US are beginning to peak. Hospitalization rates are still below where they were in the third wave. So we'll see. I think I worry about, and same with Canada and the Canadian provinces, as we move more indoors. I know cases of late have been ebbing a bit. Do we see another rebound, a jump in cases? And it can be the same in the US, particularly the northern states. More people head indoors as we get into the cooler temperatures. So that's an uncertainty, but you're right. I don't know when that's going to open, and I can't explain fully why the disconnect of why Americans are allowed in, but I'm wondering, there's usually a political explanation at the core.
Yes, Raul from MNP says it's got to do with Mexico and keeping the land border close to them. We are collateral damage. So I guess if they open up Canada, Mexico is going to say, what about us?
That's a very good point. Excellent point.
Different countries
definitely playing into it. Yeah.
Yeah. Well, if there aren't any other questions, I guess we'll wrap. We're running over time, but it's wonderful, Derek, to have had you with us this morning. Thank you very, very much for this. We look forward to having you back with probably revisions on your forecasts or scenarios. And we wish you well. We wish everybody safe travels and safe and good business. And we have a webinar tomorrow, which is from KRB Law, and we hope you'll all join us for that. Thank you, everyone.
Merci too.
Okay, Derek. All the best.
Merci.
Thank you.